throwing away money without even realizing it. With the down economy, many of you have been asking, how can you save for retirement when it costs a lot just to live?
Yeah, 4029's Jay Plyburn met with financial advisors who say if you plan it right, you can save $1 million by the time you retire. It's a story you'll only see right here on 4029 News.
Saving money is easier said than done. We're constantly being tempted by special deals and promotional offers on everything from food and clothing to automobiles. But if you don't start saving early, you could be left with nothing when you retire.
You can either enjoy it now or more enjoy it in retirement.
For nearly 30 years, Stan Eden has been helping people build their retirement funds.
The main thing we try to get across with people coming in is be safe, save as much as you can. Okay, don't take a lot of risk.
Sounds simple, right? But according to Eden, many people are making huge mistakes.
You just can't choose an investment and sit back and let it work for you anymore. It doesn't work that way. So you've got to be actively involved in the investment and seeing what's going on then.
He says you always need to check your monthly and quarterly statements in order to stay up to date, but there's much more to it than that. Sandra Novak is a retired registered nurse who says one of the things that helped her build her 401k was her company, which matched dollar for dollar what she put in.
I think it could be higher, but then relatively with the stock market, some of it kind of bounces back and forth, but I think that I've done as well as I possibly could do in this economic environment that we have.
Her advice is simple: save as much money as possible.
You can't save enough no matter what you do, because you never know how your lifestyle is going to change or if your health situation is going to change in the future, and it's better to be safe than sorry.
Another mistake you could make: overfunding your 401k.
Only contribute up to the match. Take the employer's free money because most likely taxes will be higher in the future. So take the difference between what you are overfunding the 401k, find some tax-free investments.
The average age of retirement in the United States is about 60 years old, so is it possible to be a millionaire by then? Hansmann says yes, but it's not easy.
If you're 30 years old, and if you can get yourself a 10% rate of return, $500 a month will put you at a millionaire 30 years down the road.
But let's be honest, 10% is not a feasible interest rate. So we crunched the numbers again with a 6% rate of return, and the only way to have $1 million by the age of 60 is to stash away $1,000 every month.
You put $1,000 a month away for the next 30 years. You're 30 years old, so when you turn 60 at a 6% rate of return, you'll have $1 million as well.
Of course, if you started earlier, it wouldn't be as difficult. The question becomes, when should you start saving?
Is it ever too early to start saving?
No, never too early.
The sooner you do it, the better.
Mm-hmm.
Walt and Diana Page say the secret to success is putting money into a retirement fund early on.
If you don't see it, you're not going to miss it. And we haven't done without, thanks to the Lord's blessings.
They say building a 401k wasn't always easy, but they're thankful they stuck to their guns.
There would be times I'd want to do something, or, well, why can't we get this? Or our friends would be traveling, and he said, well, we could have. But he was wise in putting the money away.
For me, it all goes back
all
to
in this Bible. And so
God's word that says you're to be a good steward with what you have. And that was enforced throughout my growing up years with my father.
So in order to achieve your retirement goals, there are 3 things you need to do. Start saving as soon as possible. Take advantage of companies that will match your 401k, even if you have to start with only 1% and only contribute up to the match. Do those 3 things, and you could be spending every day on the golf course. Jay Plyburn, 42.